Welcome everyone and hello. Thank you for joining us today. I'm here on behalf of Impact ON. My name is Michael Norris and I am the Senior Director of Impact here at Impact ON, working specifically on business succession and finding the right model for entrepreneurs and founders who are seeking to develop continuity in their business and strategies that enable continuity when they are no longer at the helm. I'm here thanks to the town of Whitby that has sponsored my presence in bringing this webinar forward. So thankful for their support and our ability to work together to provide this content to you today. So this webinar will go through three parts. First, we will talk about assessing the business and maximizing your business's value, why you might want to do that, what it looks like to identify successors, and certain tax and capital gains implications, again, at a very introductory standpoint. Once we've completed this, we'll move into the transition aspect, and this will be a separate element of the webinar, and then we'll go into some case studies and look at some co-ops and trusts and employee ownership, which are just some options to consider when you're looking to develop business continuity and business succession plans. So as mentioned, this morning, what we'll be doing is we'll be assessing your business or maximizing its value, looking at who those list of potential successors may be, as well as those tax and capital gains implications. This is the first part of a three-part webinar series that will be of a bit different length depending on the content that we are addressing. Next, we're looking at the transition and looking at that management and leadership transmission, the legal aspects, as well as those case studies. Maybe a little bit about myself. So my name is Michael Norris. As I mentioned, I'm the Senior Director at Impact ON. I'm an economist by trade, and I've worked in small to medium enterprise capitalization as well as sustainable development, specifically in cooperative development as well. I have some experience and over 1,000 entrepreneurs supported. So a breadth of knowledge in multiple sectors. And I would say some of the sectors that interest me the most are definitely logistics, food, and consumer discretionary. But I've worked, across the board when it comes to even working in the housing sector. I've done some work there, and in small to medium businesses of all sorts, whether they're administrative, consulting, tax, legal, financial. I've worked in those sectors as well. And just a bit of a fun experience here. I was on the James Bay coast in a northern community in Ontario, working on business succession with a small business that you see there. And I'm sitting outside of the window of the small business that we were helping build a succession plan in order to ensure that the community retained access to vital goods like groceries and takeaway meals and things like that that are just a little bit harder to come by in that area. So some of you maybe may know the TV show Succession. It's a very interesting, great TV show that if you haven't watched, talks about a family of a media magnate and mogul that is seeking to build business continuity for the media business and is working with their next of kin in order to be able to do that. Obviously, it's quite dramatic. There's backstabbing, there's side stories, there's all the sorts of things that your business succession probably won't have, and is very much a dramatization, but nevertheless, certainly an interesting story, and it can give you a little bit of an avant-goût, as we say in French, a little bit of an appetizer as to what the succession process can look like in the worst of cases. And so just kind of before we get into the nitty-gritty of this training today, I wanted to talk about what is business succession, and I wanted to define it for you because definitions can vary, and I wanted to make sure that you're aware of kind of my approach when I'm talking about business succession with enterprises. What is the context that I'm bringing? And so my definition is really, business succession planning is the process of deciding who will take over your business in the future when you retire or the unexpected happens. Okay, so that's the definition textbook that I like to bring forward to people and share with people. Another easier way to put that, just in one sentence, is what is my legacy, my impact, if I'm the only one who does what I can do? Obviously, there is no legacy and no impact if you're the only person who does what you can do. So how are you going to prepare your business for when you're no longer at the helm in terms of a business continuity? Because that's a huge risk for businesses to take into consideration. I like to start my trainings with two truths and a lie. So I have some statistics up here. We have the first one, which is 65% of SME founders in Canada seek to exit their businesses in the next 5 years. And in North America, 12 billion businesses will change hands in the next 5 years. And then 60% of founders are seeking to close or liquidate their business in the next 5 years. So just give you a chance to read them over, maybe develop some thoughts. 2 of them are true, 1 of them is false. I'll give you the answer in just a moment. So the third one is false. And so while 55% of founders, do want their businesses sustained, 32% will be forced to close or to liquidate their businesses. Okay. So the vast majority of businesses and founders are seeking continuity of their businesses. The unfortunate reality is that a large minority will need to close or liquidate their businesses because they have no succession plan. And so this is where we come in. How do we avoid a liquidation and prepare our business succession correctly? This is what we're going to be talking about. We have 6 steps, and if you follow these 6 steps, you should get a better sense of what you need to do to implement a business succession strategy. The first thing to do, and the first thing that's most important, is to determine the value of your business. Is it worth $1, $5, $500, $5,000, or $500,000? That's a good question to answer, right? Because ultimately, that's going to have huge implications on how you transfer your business and the money that you ultimately end up getting in the event of an asset sale as well. But how do you determine this value? The easy answer is to have your business appraised, okay? Easier said than done. You should do it every 5 years is my recommendation. And you can do this through what's called a business appraiser. So it's an expert in a given sector who will sit down with you, take the time to fully understand your need for a business appraisal, will hopefully ask the right questions to understand your business appropriately, thoroughly explain their processes and methods to be able to determine the business valuation, and provide you with some recommendations on how to maximize the use of the appraisal as well as how to maximize the value of the business. This is really important for those who are considering selling or buying a business, growing a business, or as well as tax estate planning as well. When you're considering updating your will or considering opening a trust. Considerations like that are very important in order to be able to have your business appraised. And so that's one way to do it. What are the strategies that these business appraisers use? You might be curious as to what they'll do or what they'll suggest, just in case you want to take a stab at it yourself. One of the first things that they'll probably do is tally up the value of your assets. And so if you're an asset heavy business, this is probably very useful as opposed to maybe an asset light business. Add up the value of everything your business owns, all the equipment, all the inventory, subtract any debts, liabilities. Then the value of the business based on an asset valuation is the balance sheet, in terms of a starting point of determining the business's worth. The limitation of this sort of analysis is that a business is so much more than just its assets, right? The value that you bring as a founder is that you're putting those assets to work. And so how much more in terms of value can you extract when it comes to business succession? What is the value add, your value proposition that you're ultimately bringing to those assets? That's something that we're going to discuss in the next recommendation and the next strategy. Another way to do it is to base it on revenue. Okay, so you have those assets, you're exploiting those assets, and you're generating revenue and sales. How much does the business generate in annual sales? Calculate that and determine, through a business broker or business evaluator, what a typical business with that, amount of revenues in that line of business might be worth at a certain level of sales, right? So I'm not saying look necessarily to the stock market, but there's plenty of private businesses that have valuations done, and there's data that's available on valuations within a given sector as well that might be interesting for you to explore. They might be data sets online that cost a little bit of money, or small business enterprise centers might have access to some of these data sets as well. For example, in certain sectors, it might be 2 times sales or 3 times sales. Okay, that might be a good way to estimate the valuation of the business, because that's the value of you exploiting the business. Okay. You can use earnings multiples too. This depends on kind of how financially or how financialized the business or the structure is. A more relevant measure might be a multiple of the company's earnings. And so the actual profits that you take away in terms of a business, that's the value add that you bring in exploiting your business. Estimating the earnings of a company for the next few years. If a typical PE ratio or price to earnings ratio and the projected earnings are $200,000 a year, the business would be worth $3 million. This is an example of a business evaluation or a business appraisal when it comes to a multiple of the profits that you are making. Oh, excuse me. You can do a discounted cash flow analysis. So what is a discounted cash flow analysis? As you may notice, we're getting more and more complex and complicated with all of the recommendations that we have. And so the discounted cash flow analysis is a complex formula that looks to do the business's annual cash flow estimations, project them into the future, and then discount them to the value of those cash flows today. What do I mean by this? Say I'm investing money in the stock market today, or in bonds, or any sort of debt or equity asset. Because of inflation and real growth in returns, that amount will likely not be worth the same amount as it is this year, next year. The goal would be eventually that those values, that asset, that cash that I've invested ends up growing. And here lies kind of the problem with just doing a standard cash flow analysis, is that you're generating cash flows today, tomorrow, next week, and next year. But those cash flows are not worth the same thing to an investor, an appraiser, or a buyer. Cash flows now are much more valuable than cash flows in the future, because we have to wait, and there's a time value of money. And so a discounted cash flow analysis takes that into consideration using a net present value calculation, which is an economic calculation and a formula that can be quite complicated, but it's easy to understand, especially when you use some of the calculators that are available online. Okay, they'll ask you to put in your cash flows for any given year, determine the current interest rate environment, what is inflation, and then they'll do the discounting for you. The other thing that I recommend is to go beyond financial formulas. Don't just base your assessment of the business's value on number crunching, right? Consider the value of the business, the brand, the intangibles, the geographical location. What are the macroeconomic factors of maybe the neighborhood? Is it growing? Is it getting smaller? Is it getting younger? What are the tendencies? And consider the value of the business to a would-be acquirer as well. One of the things that I often tell people who are working to develop business succession plans is that when you're looking to sell a business, you want to make sure you sell it to the right buyer, because the right buyer will associate a value that is just and equitable for you as a founder and what you've built in terms of hard-earned equity in the business. Don't just sell it to an organization that's going to roll it up and that's going to pillage it, and that is ultimately going to take what they want and get rid of what they don't, right? So that's the formula for the net present value, evidently a bit complicated, but as I mentioned, there are calculators online, very easy to be able to determine what those cash flows are worth from year to year to be able to do that addition and assessment of the value of the business. That's only step one. We're moving into step two now. So the step two is that you're going to want to maximize the value of your business. Now, this sounds a little bit backwards, right? Because maybe you're thinking, well, I want to maximize the value of my business so that I get top dollar when I ultimately end up selling. But why would that be doing a favor to the seller at all who maybe wants to get my business at the best price? Well, by maximizing the value of your business, you're setting your business up to success, and you're setting up the successor who's buying over your business for success as well. And I'll explain why. Ideally, a company's brand is completely dissociated from the founder at succession. And this is a problem that founders have, is that, you get so involved, your sweat equity is really in the business, and these businesses tend to revolve around the heads of their founders. But if your business depends on you and just you and only you, then how are you going to ensure a viable business succession? Who would want to buy that business if you're no longer at the helm of something that only you can run? The more you've disassociated yourself from the business, the better your return on investment, right? And so maximizing your ROI is in the best interest of not only you, but it's in the best interest of your employees, your clients, and your suppliers. You've set them up for success because the business is then running itself. The question I get is, well, how do you do that? That sounds great, Michael, but how do I actually implement that? What does that look like? When it comes to considering business succession, and I know there's a lot of conversations about marketing, but there's two considerations that I think are important when it comes to marketing and business succession. One of the things you want to consider is where you're spending your marketing money. Are you spending it on acquiring new clients or retaining existing clients? One of the things that you're going to want to do in any business succession process is consolidate as much institutional knowledge as possible about how their business is run, who the clients are, and what they like. I'd recommend implementing a customer relation management system, a CRM, if you haven't already done that, to preserve those client interactions as institutional knowledge within the business. And even an optimized newsletter database is a value add, okay? Anything that consolidates a list of your customers and how they interact with the business is going to help any business successor or any business buyer develop the business post and to be able to kind of project themselves in your vision for how you sought to develop the business as well. You can use AI-based tools. That certainly this is a lot of work, but there are some CRM automations. There are some content generators that exist of these days to be able to automate marketing campaigns. You can also contract it out and use an external agency. Not maybe the consideration all of the time, understanding that small businesses are pretty cash strapped. But when you're considering maximizing your ROI for business succession, that's probably something that can bring back a significant amount of value to you and the future owner operator of your business. One of the things that I like to recommend that's very concrete and kind of handbook style, 20% of your marketing budget should be focused on winning new customers when you're looking at business succession and you're in the thick of it in terms of that process. 80% of your budget should just be devoted to client retention and supporting your clients during the transition process. Because ultimately, having a strong client base is going to be able to ensure that the business thrives well beyond your departure. When you're considering all of these things, one of the things that's very important is maximizing shareholder value. Maximizing shareholder value not only for you, but for the person taking over your business as well. as I mentioned, at the beginning of the presentation, there are a bunch of founders that abruptly close their business. There are a large minority of businesses that are passed on to their next of kin. And then there's a whole bunch of businesses that are kind of in the middle. And what do all these businesses do that I see everywhere is they mix a lot of business and personal expenses. It's convenient. It's easier. I understand. But the problem with mixing business and personal expenses is that when you come to the succession process, you are misrepresenting the profits that your company can ultimately take. And that can impact shareholder value. And so one of the things that I like to recommend is if you are planning on business succession, you'll want 2 to 3 years of clean and separated books before the transaction. Why? I think the answer is pretty evident, but I'll provide you with some examples. There is a risk of a CRA audit after you leave. How is the new founder going to, or the new manager of the business going to understand what those expenses were and to what part of the business they were associated? There's underestimated profits. And so if you're running personal expenses otherwise through the business, you're possibly reducing the ultimate net income of that organization. And if you're minimizing the net income for any sort of tax or capital gains reasons, you're also potentially making it more difficult for the new successor to be able to access capital. Why is that? Because the more earnings you can make per the value of the business, the better valuation that your business is going to have, and the more capital you're going to be able to mobilize at a lower interest rate and a lower risk of dilution. And that's one of those things where if you consider that your business has a 5 times sales valuation or a 3 times net profit valuation, reducing costs by $50 can bring you back up to $250 in value. And so when you consider separating those expenses, think about that. That subscription, that Spotify subscription that I use to put on music in the office, great. But my use of that Spotify subscription, that family subscription outside of work, if I were to take that out at $19.99 a month, that brings back potentially $80 to $100 in value for the organization. Okay. And it's a question of what would you prefer? Then the last thing is to get as much inventory off of your books as possible before the transaction. This is very important. Third step is identify possible successors or buyers, right? One of the things that we mentioned, find the right buyer and you'll get the right value, right? And that buyer may be closer than you think. So the first group that we think about is friends and family. So when you're thinking about succession, maybe think about, is there someone close to me who's been involved, who has taken an interest in my business? Sometimes it's quite unassuming. You might be surprised at who has taken an interest in your business and might want to take it over. What training does this person need to succeed in the business once you've identified them? And how do you impart the values that you've instilled in your business on that individual, right? Because those values need to continue in order for the business to be able to thrive. And what are the transition terms that you'll set up with that individual? Maybe consider a family trust. Maybe sell the company to your relative as with any other person. Don't give them any preferential treatment. Use a broker if necessary in order to be able to protect your relationship with that individual. Another group might be private equity individuals and consortiums. So when I give this presentation at business forums, one of the things that happens very commonly is you'll have these business investors who come up to you after and give you your card, and they'll say, if you know a business that's interested in selling, tell them to WhatsApp me or to call me or whatever, because they're looking at acquiring businesses, right? These businesses and these investors normally purchase businesses and they'll aggregate businesses from brokers, okay? What is a business broker? They're also known as a business transfer agent or an intermediary. They exist in Canada and in the US to help buyers and sellers of privately held businesses buy and sell and transact those businesses. They can also help with estimating the value of the business. They can have kind of a dual role as an appraiser. And they can help advertise and market that your business is for sale on various resources and websites. I've even seen some on Facebook Marketplace, for example. But one of the things that they give you is they give you that identity protection because they're not disclosing who you are and who your family is, protecting you from the potential buyer, and just keeping the conversation as focused on the business as possible. They can handle the initial potential buyer interviews, discussions, negotiations with prospective buyers, and really only bring that person in so that you're meeting them significantly down the line after everything has been considered. They can also facilitate the process of the due diligence and assist with the business sale as well. And so all of these things obviously cost money. Is it obligatory to be able to need to use a business broker in Canada? It is not required by law. So you can buy and sell your business as you'd like. One of the things that's very important before you kind of get far down a road with a business broker is to understand their marketing plan. A good business broker will adopt a comprehensive marketing strategy to promote your business effectively and will be transparent about that. Understand the plan, ask about their target markets and their promotional channels, the confidentiality measures that they put in place, and the level of effort that they will dedicate to find qualified buyers. You don't just want any buyer of your business, you want the right buyer because that's where you'll get the right value. And sometimes that takes some time, and sometimes business brokers don't like waiting. Understand the relationship between the broker and the buyer as well. Have they worked in the past together? Have they conducted transactions in the past? Is there any sort of possible collusion that could take place? Some brokers may want to prefer to work with certain buyers and not others. And what I would just recommend that you do is in those instances to understand why. What does it cost to use a business broker? Normally, the seller pays the broker fee unless the buyer is also working with a broker, in which case the broker normally charges a fee of 10% of the sales price. The brokers may split that commission between the two of them. If it's a buy side and a sell side broker who are working together, you can choose to work with a buy side or a sell side broker. Consider asking whether the listing broker will split their commission with a buy-side broker. Some won't, and it would be just important to consider, okay, how are those fees ultimately being paid at the end of the day, and how's that impacting you and the windfall that you are going to get from your business. Brokers often benefit from expediting the process because they get their commission a little bit faster. Not necessarily the case of business owners. If you want business continuity, business succession, and you want the right value, be prepared to wait. And this is why we're talking about this now, because good businesses think about this early. They don't think about this at the time of sale. At the time of sale, you're leaving money on the table and you're liquidating. You're doing it quickly and you're not setting yourself up for success. So, just kind of wrap up this discussion with the business broker do's and don'ts. Use a business broker to protect yourself and your identity throughout the transaction. You have a right to privacy in these negotiations, and to use a broker with whomever you want, even if it might be a friend. Rely on the due diligence that the broker does and on your own due diligence as well. They always say trust but verify. A broker is a broker. They may not be an industry expert in your domain. And don't take their word for it. Get a second opinion if you want to get a second opinion on the business valuation. And don't neglect to get everything in writing. Verbal promises are always easily disputable. Third group, employees. This is a group that is gaining some considerable traction. Generally a situation occurring when, no buyers show interest in taking over the business or the employees fear for their jobs. There's also a lot of founders who have a vested interest in selling to their employees because your employees know your business the best. Employees must acquire the equity of the company or the assets of the company, just as any other purchase or sale of a business. However, there are different transition terms that can be exploited, and one of the things we'll talk about in the third webinar of this series is that employees can take over the company as is, or they can create a separate entity, such as a workers' co-op or an employee ownership trust, and that there are favorable tax considerations for people who may want to do one of these two things. Group 4 is suppliers. So, we said your employees know your business best. Your suppliers may also know your business quite well. And they may have an interest in expanding vertically up and down the value chain. There's no particularly magic sauce to preparing your business to a sale of a supplier. I would say it's quite popular. But just anticipate any change management and identify those synergy opportunities to ensure that you are maximizing the value perceived on your end that this supplier wants to potentially exploit within your business, and kind of try to estimate where they would ultimately take the business, so that you can include that in the negotiating leverage. Make sure you meet all regulatory requirements. This might be, just kind of competitively make sure that there is no antitrust implications, or that the Trade Commission or the Competition Bureau rather might not have any sway in the negotiations, but I imagine that for the most of you that won't be a consideration. And in terms of the transition terms, it's either generally one supplier buys the company, or multiple suppliers could create a retail distribution co-op and buy your company or acquire via a joint venture. So it's possible to sell to one supplier just as it is possible to sell to multiple suppliers. Customers know your business very well as well, and they might have an interest in a vertical integration up the value chain. And so anticipate change management as you identify synergy opportunities. This is quite similar to a sale with suppliers. Make sure you meet the regulatory requirements as well with the Competition Bureau. And then the same thing here, one customer could buy your company, or multiple customers could create a producer distribution co-op and buy your company or acquire it by a joint venture. I think we're getting to the last of the groups here, competitors. And so evidently you may have a competitor who has shown an interest in a horizontal integration across the value chain. Evidently, when competitors acquire other businesses, the Competition Bureau of Canada reserves the right to approve the acquisition, as per Section 92 of the Competition Act. Certainly when it finds that a merger prevents or lessens or is likely to prevent or lessen competition substantially. This was evidently the case when RBC acquired HSBC. The Competition Bureau took a look at it and approved it, but they reserve the right to take a look at those transactions if they have a vested interest in it. Obviously, the transition terms are just like the acquisition of any other business, either an asset or an equity purchase, takeover bid, a merger, a joint venture, strategic investment. And again, that can be a friendly bid or a hostile bid. We heard recently that Alimentation Couche-Tard, the convenience store chain in Canada, sought to take over 7-Eleven, which was a Japanese firm, and that there were questions of whether that was a friendly or hostile takeover. Friendly or hostile just means whether it is solicited or accepted generally positively by the shareholders of the targeted organization. So again, we're still in that pre-sale stage. I told you there were 6 steps. We're getting into step 4 here, which is determining the best practices for tax and capital gains during succession. You want to make sure that you have the most money when you leave your business, because you're maximizing the business equity, profitability, not only for yourself, but for the successor. 2 fundamental ways to be able to monetize your business in an exit, asset sale or an equity sale. So the asset sale transfers ownership of certain tangible and intangible assets to the buyer rather than transferring ownership of the actual business. One way to think about this is to think about, going into a grocery store and the buyer picks out what they want to buy and they leave the rest. An equity sale is when the current owners sell all of the outstanding shares or interests to the business of the buyer. So instead of, going into a grocery store and buying the individual items, you buy the whole store. There are advantages and disadvantages for buyers and sellers when it comes to asset sales. Okay. One of the advantages of asset sales is the flexibility and the liability retention that you are able to generate as a result of an asset sale. So you can sell specific assets, but retain others that you would otherwise want to retain. Sellers can also retain certain liabilities for better control of the terms of the sale. There's also a flexibility in the negotiating pricing of the individual assets, maybe seek higher valuations on products and assets that you think will be strategic to the buyer. However, there are tax implications of asset sales as well. There's higher taxation for sellers than an equity sale because you're taxed potentially on different values of assets as opposed to the capital gains on the actual business. The negotiation can be a little bit more complex and time consuming because you're taking an inventory of all the items and then you're having to go through with the seller to see what they want and don't want. And then following an asset sale, the business entity actually remains completely untouched and you remain the owner of that business entity. And so since the business is technically continuing, even though the assets have been sold, you are still liable for any debts owed by the entity. Okay, so those are the advantages and disadvantages of an asset sale. What about an equity sale? There's certain tax benefits to the seller. So there's a more favorable tax treatment. We'll get into that in a little bit when compared to an asset sale for a seller. It's a little bit simpler, more straightforward. You're just selling the whole entity. And so the structure of the sale will just be a little bit easier to understand. And it allows for a complete exit of you and your family. Allows sellers to achieve a clean break from the business where the buyer assumes those assets and liabilities. What you may need to provide the seller or the buyer rather in an equity sale is a purchase price reduction because the buyer has some foregone tax benefits when you're looking at an equity purchase or an equity sale of the business. There's certain regulatory approvals that may need to be considered as opposed to an asset sale, which is just the sale of the actual asset. And there might be some legal considerations or restrictions in certain sectors. And there might be some further assurances or future assurances that you need to provide to the business buyer from, indemnities, warranties that you may have provided to customers or unknown liabilities that come up to bite the buyer further down the road. And so as a result, there might be a certain value of the business or a certain amount that is placed into escrow in order to be able to account for those indemnities, warranties, or unexpected unknown liabilities so that the buyer can potentially claw back certain amounts to be able to cover those further assurances if necessary. I hope that was clear. One of the things, and I understand that this slide is a little bit long, but I assure you that it's quite important to understand here. And one of the reasons for including this is you may have figured out in the previous slide that there may be some advantages to an asset sale for a buyer, and there may be some advantages to an equity sale for a seller. And so how do you reconcile the fact that, a buyer may want to do a transaction one way and a seller might do a transaction the other way, and what are the considerations? I'll give you an example here that hopefully will clarify for you what the incentives are for a buyer to want an asset sale and a seller to possibly want an equity sale. And it's based on kind of tax and capital gains considerations within Canadian tax law. So take, for example, a seller that decides to sell their company for $10 million. The company has no operations, and its sole asset is its equipment that it originally purchased for $7 million. Okay, so we're selling for $10 million, acquired the equipment for $7 million, but it has appreciated $5 million over the last few years. Their depreciation has reduced the seller's equity basis from the original 7 million to 2 million. Okay, that's just 7 minus 5. If the transaction is structured as an equity sale, the seller would have a capital gain of 8 million, okay, and would owe 1.6 million in taxes. So basically 20% of capital gains on that $8 million. If the transaction was structured as an asset sale, the seller would actually owe 2.4 million in taxes because the $5 million of the depreciation of the asset can be recaptured at the 37% ordinary income rate, and the remaining 3 million gain taxable at the 20% long-term capital gain rate. So the 3 million is the difference between the 7 and the 10, and then you're able to recapture the government is able to recapture some of the depreciation that would be taxable at 37% of the $5 million. So as such, the buyer can benefit from a stepped up tax basis on the acquired asset. So increasing the basis of the assets for tax purposes allows the buyers to depreciate the asset and generate tax savings. That's why a buyer can benefit from an asset sale as opposed to an equity sale. Whereas equity sales don't provide such advantages to the buyer because they're acquiring the business as well as all the depreciated assets inside of it. And the business's existing tax basis as well. So as a result, buyers can often want to negotiate a lower purchase price to compensate for any foregone tax benefit when you're looking at an equity sale. And that's one of the reasons why there might be a discount when it comes to both considerations. And so ultimately, the conclusion that I want you to draw from this slide is choose the best method for you and find the right buyer that's able to get a deal done and understand the incentives or disincentives to the different types of considerations as well. All right. Thanks so much. This is the first part. I've left my email and my contact information here. If you have any questions, please do not hesitate to contact us, and I will be happy to provide you with any sort of insight. We try to do this pretty frequently, and I will get into the next second part of the webinar now. This was the first part. I hope you've enjoyed it, and I hope you enjoy the second part as well. Thank you very much.